General rule: when one insures his own life, he may designate any person as the beneficiary, whether or not the beneficiary has an insurable interest in the life of the insured. Exceptions: persons specified in Article 739 of the Civil Code cannot be designated, like those who made between persons who were guilty of adultery or concubinage. Conviction is not a condition precedent. Now, letter B, those made between persons found guilty of the same criminal offense in consideration thereof. And letter C, those made to a public officer or his wife, descendants, or ascendants by reason of his office. In order for Article 739 to apply, it is not required that there be a previous conviction for adultery or concubinage due to the wording of preponderance of evidence. Insular life versus Ebrado. When is the state entitled to the proceeds of the insurance? Where the insured has not designated any beneficiary, or when the designated beneficiary is disqualified by law to receive the proceeds. Heirs of Maramag versus Maramag. Note, the designation is recoverable unless the right to revoke is expressly waived in the policy. If the insured or beneficiary is a minor and the amount involved does not exceed 50,000 pesos, the father, or in his absence or incapacity, the mother may exercise the minor's right under the policy without the need of a court authority or a bond. If the premiums are paid out of the conjugal funds, the proceeds are considered conjugal. If the beneficiary is other than the insured estate, the source of premiums would not be relevant. BPI versus Posadas. Does the insured have the right to change beneficiary in life insurance? General rule: the insured shall have the right to change the beneficiary he designated in the policy. Exception: if the insured expressly waived his right to change the beneficiary. This makes the latter an irrevocable beneficiary, but despite the waiver, he can still change the beneficiary provided that he obtains the beneficiary's consent. When can the interest of a beneficiary in an insurance policy be forfeited? The interest of a beneficiary in a life insurance policy shall be forfeited when the beneficiary is the principal, accomplice, or accessory in willfully bringing about the death of the insured, in which event the nearest relative of the insured shall receive the proceeds of said insurance if not otherwise disqualified. The share forfeited shall be paid as follows: to the other beneficiaries, if not disqualified. Letter B, if no other beneficiaries in accordance with the policy contract, that is, to the contingent or substitute of beneficiaries. Letter C, if policy contract is silent to the estate of the insured. Insurance Code Section 12. In property insurance, to what should insurable interest pertains to? Property itself. B, any relation thereto. C, liability in respect thereof. Section 13. In property insurance, what may consist insurable interest consist in? An existing interest, an inchoate interest founded on an existing interest, or C, an expectancy coupled with an existing interest in that out of which the expectancy arises. How is insurable interest in property measured? The measure of an insurable interest in property is the extent to which the insured might be indemnified by loss or injury thereof. In general, a person has an insurable interest in the property if he derives pecuniary benefit or advantage from its preservation, or would suffer pecuniary loss, damage, or prejudice by its destruction, whether he has or has no title in or lien upon, or possession of the property. Hence, pecuniary interest over the property is always necessary. Existence of insurable interest is a matter of public policy. Hence, the principle of estoppel cannot be invoked. Distinguish between insurable interest in life and in property. In life, it may be based on pecuniary interest, affinity, or consanguinity, while in property, it is based on pecuniary interest. In life insurance, at the time the policy takes effect and need not exist at the time of the loss. Under property, it must exist when the insurance takes effect and when the loss occurs, but need not exist in the meantime. Under life, as to the amount of insurable interest, the general rule is no limit, except if insurable interest is based on creditor-debtor relationship only to the extent of the creditor or death. The beneficiary need not possess an insurable interest in the life of the insured. Under property, it is limited to the actual value of damage or injury or loss, and person to whom loss is payable must have insurable interest in the property insured. What is the effect of the change in the interest of a thing to the insurance policy? General rule, a change in interest in the thing insured without a change in insurance does not transfer the policy but suspends it until the interest in the thing and the interest in the insurance are vested in the same person. Exceptions. Section 20. Life, health, and accident insurance. Section 21. A change of interest in the thing insured after the occurrence of an injury which results in a loss. Section 22. A change of interest in one or more or several things separately insured by one policy. Section 23. A change of interest by will or succession on the death of the insured. Section 24. A transfer to interest by one of several partners, joint owners, or owners in common who are jointly insured to the others. And Section 57, when a policy is so framed that it will inure to the benefit of whomsoever during the continuance of the risk may become the owner of the interest insured. Note, when there is an express prohibition against alienation in the policy, in case of alienation, the contract of insurance is not merely suspended, but is avoided. What change of interest suspends an insurance contract? The change of interest contemplated by law is an absolute transfer of the insured entire interest in the property insured to one not previously interested or insured. In the following cases, the policy is not suspended. A. Execution of a mortgage. B. Lease of the insured property. C. Vendor who has a lien on the property sold until the purchase price is paid or the conditions of the sale are performed. D. Judgment debtor whose property has been sold on execution. E. Mortgager whose property has been foreclosed. Note, in a chattel mortgage, there is no alienation within the meaning of the insurance law until the mortgagee acquires the right to take possession of the property by default of the mortgager under the terms of the mortgage. Q. What are the rules on the extent of insurable interest in a mortgage situation? Interest is separate and distinct from the other. In case both of them take out separate insurance policies on the same property, or one policy covering their respective interests, there is no double insurance. Mortgager, as owner, may insure the property mortgage to the full value of such property. Mortgagee can insure the same only to the extent of the amount of his credit. What are the rules on insurance policy taken by the mortgager for the benefit of the mortgagee, or policy assigned to the mortgagee? The insurance is still deemed to be upon the interests of the mortgager, who does not cease to be a party to the original contract. Number 2. Any act of the mortgager prior to the loss, which would otherwise avoid the insurance, will have the same effects. Although the property is in the hands of the mortgagee, any act which under the contract of insurance is to be performed by the mortgager may be performed by the mortgagee with the same effect as if it has been performed by the mortgager. Upon the occurrence of the loss, the mortgagee is entitled to recover to the extent of his credit, and the balance, if any, is payable to the mortgager, since such policy is for the benefit of both the mortgager and the mortgagee. Upon recovery of the mortgagee to the extent of his credit from the insurer, the mortgager is released from his indebtedness. What happens when the mortgagee takes an insurance for his own interest? The mortgagee may collect from the insurer upon the occurrence of the loss to the extent of his credit. Unless otherwise stated in the policy, the mortgager has no right to collect the balance of the proceeds of the policy after payment of the interest of the mortgagee. The insurer, upon payment to the mortgagee insured, becomes subrogated to the rights of the mortgagee against the mortgager and may collect the debt of the mortgager to the extent of the amount paid to the mortgagee. What is the standard or union mortgage clause? If a fire insurance policy contains this, the acts of the mortgager do not affect the mortgagee. It makes a separate and distinct contract of insurance on the interest of the mortgagee. What is an open or loss payable mortgage clause? It is a contract which provides that the payment of loss to the mortgagee, if any, will be according to his interest as it may appear in the contract. Under such clause, the acts of the mortgager will affect the mortgagee. What is double insurance? It exists when the same person is insured by several insurers separately in respect to same subject and interest. It is not prohibited by law, but it may be contractually prohibited by another insurance clause. When there is double insurance and overinsurance results, the insured can claim in case of loss only up to the agreed valuation or up to the full insurable value from any, some, or all insurers without prejudice to the insurers ratably apportioning the payments. Insured can also recover before or after the loss from both insurers the excess premium he has paid. What are the requisites of double insurance? A. The person insured and injured is the same. Letter B. There are two or more insurers insuring separately. C. The subject matter is the same. D. The interest insured is also the same. And E. The risks or peril insured against is likewise the same. What is overinsurance? It exists when the amount of insurance is beyond the value of the insured insurable interest. In case of overinsurance by double insurance, insurer is not liable for total amount of insurance taken. His liability is limited to the amount of insurable interest on property insured. Insurer is not entitled to a portion of premium corresponding to the excess of insurance over the insurable interest of the insured. Premiums to be returned when there is overinsurance by several insurers shall be proportioned to the amount by which aggregate sum insured in all policies exceeds the insurable value of the thing at risk. Distinguish between double insurance and overinsurance. Double insurance, there may be no overinsurance as when the sum total of the amounts of the policies issued does not exceed the insurable interest of the insured. Several insurers are involved in double insurance. In overinsurance, amount of insurance is beyond the value of the insured's insurable interest, and it may have only one insurer involved. What is reinsurance? It is one by which an insurer procures a third person to insure him against loss or liability by reason of such original insurance. In every reinsurance contract, the original contract of insurance and the contract of reinsurance are separate and distinct and covered by separate policies. Distinguish between policy of insurance and reinsurance. Policy of insurance, written document embodying the terms and stipulations of the contract of insurance between the insured and the insurer. Formal written instrument evidencing the contract of insurance. Reinsurance, any contract by which an insurer procures a third person to insure him against loss or liability by reason of an original insurance. The original contract of insurance and the contract of reinsurance are covered by separate policies. How about double insurance versus reinsurance? Under double insurance, it involves the same interest. The insurer remains in such capacity. Insured in the first contract is a party in the interest in the second contract. The subject of insurance is property. The insured has to give his consent. Under reinsurance, the insurance of different interests. Insurer becomes an insured in relation to insurer. Original insured has no interest in reinsurance contract. Subject of insurance is the original insurer's risk, and the consent of original insured is not necessary. The reinsurance contracts were correctly issued in favor of Plaridel. By its nature, reinsurance contracts are issued in favor of the direct insurer because the subject of such contract is the direct insurer's risk. In this case, Pluridel's contingent liability to MSAPL and not the risk assumed under the original policy. With or without reinsurance, the obligation of the surety to the party against whom writ of assignment is issued remains the same. Is in the case of Communication and Information System Corporation versus Smart Sensing. What is compulsory motor vehicle liability? It is a protection coverage that will answer for legal liability for losses and damages for bodily injuries and or property damage that may be sustained by another arising from the use and operation of a motor vehicle by its owner. It is unlawful for any land transportation operator or owner of a motor vehicle to operate the same in public highways unless there is an insurance or guarantee to indemnify the death or bodily injury of a third party or passenger arising from the use thereof. What is a motor vehicle? It shall mean any vehicle propelled by any power other than muscular power using the public highways. Exceptions: road rollers, trolley cars, street sweepers, sprinklers, lawn mowers, bulldozers, graders, forklifts, amphibian trucks, and cranes if not used in public highways, vehicles which run only on rails or tracks, and tractors, trailers, and traction engines of all kinds used exclusively for agricultural purposes. What is the required scope of the coverage? The owner of private motor vehicles, comprehensive against third party liability for death or bodily injuries. In case a private motor vehicle is being used to transport passengers for compensation, such coverage shall, in addition, include passenger liability. Operators and land transportation, comprehensive against third party liability for death or bodily injuries. The insurer may extend additional other risks at its option. What are the rules of comprehensive third party liability insurance? Registration of any vehicle will not be made or renewed without complying with the requirements. The protection may be complied with using any of the following: insurance policy, surety bond, cash bond. The purpose of CTPL, or the Comprehensive Third Party Liability Insurance, is to give immediate financial assistance to victims of motor vehicle accidents and or their dependents, especially if they are poor, regardless of the financial capability of motor vehicle owners or operators responsible for the accident. What is a no-fault clause? The injured third party or passenger or heirs of the deceased is given the option to file a claim for death or injury without the necessity of providing or proving fault or negligence of any kind. What are the conditions for application of no fault clause? The claim must be for death or bodily injuries only, property damage liability not included. The total indemnity in respect to any person shall not exceed 5,000 pesos. This is the minimum legal limit. Insurance companies issue policies for more than 5,000 pesos. The legal limit under the new insurance code is 15,000 pesos. The following proof of loss, when submitted under oath, shall be sufficient evidence to substantiate the claim, like police report of the accident and death certificate and evidence sufficient to establish the proper payee, or medical report and evidence or medical or hospital disbursement in respect of which refund is claimed. And claim may be made against one motor vehicle only, against the insurer of the vehicle where one is a passenger. In any other case, the offending vehicle. So who can claim or who can be a claimant? The claimant or victim may be a passenger or a third party. What is a passenger? Any fare-paying person being transported and conveyed in and by a motor vehicle for transportation of passengers for compensation, including persons expressly authorized by law or by the vehicle's operator or his agents to ride without fare. What is a third party? It is any person other than a passenger as defined in this section and shall also exclude a member of the household or a member of the family within the second degree of consanguinity or affinity of a motor vehicle owner or land transportation operator as likewise defined therein, or his employee in respect of death, bodily injury, or damage to property arising out of and in the course of employment. So, from whom shall the claim be made? In the case of an occupant of a vehicle, claim shall lie against the insurer of the vehicle in which the occupant is riding, mounting, or dismounting from. If not an occupant, claim shall lie against the insurer of the directly offending vehicle. The claimant is not free to choose from which insurer he will claim the no fault indemnity, as the law, by which the word shall makes it mandatory that the claim be made against the insurer of such vehicle. That said vehicle might not be the one that caused the accident is of no moment, since the law itself provides that the party paying the claim may recover against the owner of the vehicle responsible for the accident. Per la Compañía de Seguros versus Ancheta. Note, in all cases, the right of the party paying the claim to recover against the owner of the vehicle responsible for the accident shall be maintained. What are the periods governing claim settlement? Notice of claim must be presented within 6 months from the date of the accident, otherwise the claim is deemed waived. Bringing an action or suit, the action must be filed in court of the insurance commission within 1 year from denial of the claim. Prescription starts to run from the denial of the claim by the insurance company. How about payment of claims? If there is an agreement, the insurance company shall forthwith ascertain the truth and extent of the claim and make payment within 5 working days after reaching an agreement. If no agreement is reached, the insurance company shall pay only the no-fault indemnity without prejudice to the claimant from pursuing his claim further, in which case he shall not be required or compelled by the insurance company to execute any quitclaim or document releasing it from liability under the policy of insurance or surety bond issued. Note, if the policy provides for indemnity against liability, the insurer can be sued directly by a third person, but if the policy provides for reimbursement after actual payment by the insured or for the indemnity against loss, a third person has no cause of action against the insurer. This is in the case of Bonifacio Brothers versus Mora, GR 20853. While insurer's liability may be direct, it does not mean that the insurer can be held solidarily liable with the insured. The insurer's liability is based on contract. That of the insured is based on torts. Furthermore, of the insurance coverage, Pan-Malayan Insurance versus CA. What is the authorized driver's clause? A stipulation in a motor vehicle insurance which provides that the driver, other than the insured owner, must be duly licensed to drive the motor vehicle. Otherwise, the insurer is excused from liability. The clause means that the insurer indemnifies the insured owner against loss or damage to the car but limits to the use of the insured vehicle to the insured himself or any person who drove on his order or with his permission. The clause means that the insurer indemnifies the insured owner against loss or damage to the car, but limits the use of the insured vehicle to the insured himself or any person who drove on his order or with his permission. Who is an authorized driver? An authorized driver refers to the insured. B. Any person driving on the insured's order or with his permission, provided that the person driving is permitted in accordance with the licensing or other laws or regulations to drive the motor vehicle and is not disqualified from driving such motor vehicle by order of a court of law or by reason of any enactment or regulation in that behalf. Note, if the claimant was able to present a driver's license, the same is presumed to be genuine. The license will still be sustained in the absence of proof that it was not validly issued. CCC Insurance Corporation versus CA. A driver, not the insured himself, who holds an expired driver's license is not an authorized driver. Gutierrez versus Capital Insurance. What is a theft clause? The risks insured against in the policy may include theft. If there is such a provision and the vehicle was unlawfully taken, the insurer is liable under the theft clause and the authorized driver clause does not apply. The insured can cover or recover even if the thief has no driver's license. What is the scope of life insurance? Insurance on human life. Insurance appertaining thereto or connected therewith may be payable on the death of the insured, on his surviving a specified period, and otherwise contingently on the continuance or of cessation of life. Note, in life insurance, policies are always valued policies. So what are the classification of life insurance? We have individual life. This is an insurance on human life and insurance appertaining thereto or connected therewith. Group life is a blanket policy covering a number of individuals. Industrial life is a form of life insurance under which the premiums are payable either monthly or oftener. If the face amount of insurance provided in any policy is not more than 500 times that of the current statutory minimum daily wage in the city of Manila, and if the words industrial policy are printed upon the policy as part of the descriptive matter. What are the kinds of life insurance? Whole life or ordinary policies, the insured agrees to pay annual, semi-annual, or quarterly premiums while he lives. The insurer agrees to pay the face value of the policy upon the death of the insured. Limited payment life policies, a whole life or ordinary policy where premiums are paid only for a specified period of years. Term policy means insured pays only once and insurer's liability arises only upon the death of the insured with the agreed term as period. If the latter survives the period, the contract terminates and the insurer is not liable. Endowment policy. Insurer agrees to pay a certain sum to the insured if the latter outlives a designated period. If he dies before that time, the proceeds are paid to the beneficiary. Life annuity. Debtor binds, which is the insurer, himself to pay the annual pension or income during the life of one or more persons in consideration of a capital consisting of money or other property whose ownership is transferred to him with the burden of income. What is a variable contract? Any policy or contract on either a group or individual basis issued by an insurance company providing for benefits or other contractual payments or values thereunder to vary so as to reflect investment results of any segregated portfolio of investment. What are the rules on transferability of life insurance contract? A policy of insurance upon life or health may pass by transfer, will, or succession to any person, whether he has an insurable interest or not, and such person may recover upon it whatever the insured might have recovered. All life insurance policies are declared by law to be assignable regardless of whether the assignee has an insurable interest in the life of the insured or not. Is the beneficiary's consent necessary in the assignment of the policy? The answer is the necessity of the consent of the beneficiary depends if there is a waiver of the right to change the beneficiary. What is the liability of the insurer in case of suicide? The insurer is liable in the following cases. 1. Suicide was committed after the policy has been in force for a period of 2 years from the date of its issue or its last reinstatement. Suicide committed in a state of insanity, regardless of the date of the commission of the suicide. Or number 3, if committed after the lapse of a shorter period in the policy. Any stipulation extending the 2-year period is void. The insurer is not liable in the following cases. The suicide is not by reason of insanity and is committed within the 2-year period. The suicide is by reason of insanity, but it's not among the risks assumed by the insurers, regardless of the date of commission. And 3, the insurer can show that the policy was obtained with the intention to commit suicide, even in the absence of any suicide exclusion in the policy. What is the effect if the insured is killed by the beneficiary? General rule, the interest of a beneficiary in a life insurance policy shall be forfeited when the beneficiary is the principal, accomplice, or accessory in willfully bringing about the death of the insured. In such a case, the share forfeited shall pass on to the other beneficiaries unless otherwise disqualified. In the absence of other beneficiaries, the proceeds shall be paid in accordance with the policy contract. If the policy contract is silent, the proceeds shall be paid to the estate of the insured. Exceptions: accidental killing, B. Self-defense, and C. Insanity of the beneficiary at the time he killed the insured. Incontestability clause. What are the requisites of incontestability clause? 1. The insurance is a life insurance policy. 2. It is payable on the death of the insured. And C. It has been in force during the lifetime of the insured for at least 2 years from its date of issuance or of its last reinstatement. The period of 2 years may be shortened, but it cannot be extended by stipulation. When does incontestability clause set in? Whichever is earlier, within 2 years from the date of insurance or its last reinstatement or upon the insurer's death. Sun Life versus Sebia. Note, in an earlier ruling, the Supreme Court ruled that the insured dying 11 months after the effectivity of the insurance policy allows the insurer to contest any misrepresentation made in the policy due to the 1-year incontestability clause. What defenses are not barred by incontestability clause? Person taking the insurance lacked insurable interest as required by law. Cause of the death of the insured is exempted risk. Premiums have not been paid. D. Conditions of the policy relating to military or naval service have been violated. The fraud is of a particular vicious type wherein the policy was taken in furtherance of a scheme to murder the insured. Number 2, the insured instituted another person for the medical examination. And 3, the beneficiary feloniously killed the insured. Beneficiary failed to furnish proof of death or to comply with any condition imposed by the policy after the loss has happened or action was not brought within the time specified. Offer and acceptance consensual. What is the nature of an insurance contract? Is it a consensual? It is a consensual contract. A contract of insurance must be assented to by both parties, either in person or through their agents, as so long as an application for insurance has not been either accepted or rejected. It is merely a proposal or an offer to make a contract. Perez versus CA. Also, according to Enriquez, in the case of Enriquez versus Sun Life Assurance, submission of application, even with premium payment, is a mere offer on the part of the applicant and does not bind the insurer. An insurance contract is also not perfected where the applicant dies before the approval of his application or it does not appear that the acceptance of the application ever came to the knowledge of the applicant. An acceptance made by letter shall not bind the person making the offer except from the time it came to his knowledge. Delay in acceptance. A contract of insurance, like other contracts, must be assented to by the parties, either in person or by their agents. Under the law, assent or consent is manifested by the meeting of the offer and the acceptance upon the thing and the cost which are to constitute the contract. If an application has not been either accepted or rejected, there is no contract yet, as it is merely an offer or proposal. Delivery of policy. The delivery of a policy is not, however, a prerequisite to a valid contract of insurance. The contract may be completed prior to the delivery of the policy or even without delivery of the policy depending on the intention of the parties. Is form required for the perfection of a contract of insurance? The answer is no. The policy is a formal written instrument evidencing the contract of insurance entered into between the insured and the insurer. No form is required to perfect a contract of insurance. What are the requirements as to the form of insurance contracts? No policy, certificate, or contract of insurance shall be issued or delivered within the Philippines unless in the form previously approved by the Commissioner. And number two, no application form shall be used with, and no rider, clause, warranty, or endorsement shall be attached to, printed, or stamped upon such policy, certificate, or contract unless the form of such application, rider, clause, warranty, or endorsement has been approved by the Commissioner. Note, the policy is the formal written instrument evidencing the contract of insurance entered into between the insured and the insurer. No form is required to perfect a contract of insurance. What is a cover note? It is a contract for temporary insurance for a reasonable time until the policy or policies can be written or issued by the insurer. It is also called binding receipt or slip, interim, temporary, or provisional policy. So, what are the rules on cover notes? Insurance companies doing business in the Philippines may issue cover notes to bind insurance temporarily pending the issuance of the policy. A cover note shall be deemed to be a contract of insurance within the meaning of Section 1, Number 1 of the Code. No cover note shall be issued, renewed, unless in the form previously approved by the Insurance Commission. A cover note shall be valid and binding for a period not exceeding 60 days from the date of its issuance, whether or not the premium therefore has been paid, but such cover note may be cancelled by either party upon at least 7 days' notice to the other party. If a cover note is not so cancelled, a policy of insurance shall, within 60 days after the issuance of such cover note, be issued in lieu thereof. Such policy shall include within its terms the identical insurance bond under the cover note and the premium therefore. A cover note may be extended or renewed beyond the aforementioned period written approval provided that with upon the certification of 60 days with that of the Insurance Commission, such written approval may be dispensed of the President, Vice President, or General Manager of the insurance company concerned, that the risks involved, the values of such risks, and or the premiums therefore have not as yet been determined or established, and that such extension or renewal is not contrary to and is not for the purpose of violating any provisions of the insurance code or of any of the rulings, instructions, circulars, orders, or decisions of the insurance commissioner. The fact that no separate premium was paid on the cover note before the loss insured against occurred does not militate against its binding effect as an insurance contract. By their nature, cover notes do not contain particular that would serve as basis for the computation of the premiums, and consequently, no separate premiums are intended or required to be paid therefore. What is an insurance policy? A written document issued by the insurer to the insured, embodying the terms and conditions of their contract of insurance. The policy is not necessary for the perfection of the contract. The policy is only the formal written instrument evidencing the contract. It is required, however, that all policies issued or delivered must be in the form previously approved by the Insurance Commission. The best evidence that a contract has been entered into between the insurer and the insured is the delivery of the policy by the insurer to the insured. What is a rider? Attachment to an insurance policy that modifies the conditions of the policy by expanding or restricting its benefits or excluding certain conditions from the coverage. What are the formal requisites of riders? Riders, together with other attachments to the policy like clause, warranty, or endorsements, are not binding on the insured unless the descriptive title or name thereof and written on the blank spaces provided in the policy and countersigned by the insured or owner. Exception: no need to countersign if the rider or other attachment is supplied for by the insured or owner of the policy. A rider containing an automatic increase clause, one that increases the coverage subject to the attainment of a certain age of the insured, is not a separate contract. It is part of the original policy, which is in the nature of a conditional obligation. Note, if there is inconsistency between the policy and the rider prevails, it being the latter and a more deliberate expression of the agreement of the parties. What are the formal requirements of a policy? In printed form, which may contain blank spaces, any word, phrase, clause, mark, sign, symbol, signature, number of words necessary to complete the contract of insurance shall be written in the blank spaces provided therein. What are the contents of an insurance policy? The parties between whom the contract is made, the amount to be insured except in the case of open or running policies, the premium, or if the insurance is of a character where the exact premium is only determinable upon the termination of the contract, a statement of the basis and rates upon which the final premium is to be determined, the property of or life insured, the interest of the insured in property insured, if he is not the absolute owner thereof, the risk insured against, and the period during which the insurance is to continue. What are the different kinds of policies? Open or unvalued policy. This is a value of thing insured is not agreed upon, but left to be ascertained in case of loss. Example, marine and fire insurance. In an open policy, the value of the property insured is not agreed upon, although the parties may agree on the maximum amount of recovery or limit to the liability of the insurer. In case of loss, this amount must be considered by agreement of the insurer and the insured the actual value of the property in the absence of evidence of greater or lesser value. Valued policy. This is a definite valuation because there's a definite valuation agreed upon by parties or both parties and written on the face of the policy. Example, marine and fire insurance still. Running policy, also called floating, adjustable blanket, or declaration policy. It contemplates successive insurances and which provides that the subject of the policy may from time to time be defined. What stipulations in an insurance contract are valid? These are stipulations for the payment of loss, whether the person insured has or has not owned any interest in the property insured, or the policy shall be received as proof of such interest. Policies executed by way of gaming or wagering. Premium payment. What is a premium? Premium is the consideration paid to the insurer for undertaking to indemnify the insured against a specified peril. An insurer is entitled to payment of the premium as soon as the thing insured is exposed to the peril insured against. What are the effects of non-payment of premium? General rule, non-payment of first premium prevents the contract from becoming binding, notwithstanding the acceptance of the application or the insurance of the policy. But non-payment of the balance of the premium due does not produce the cancellation of the contract. Subsequent premiums does not affect the validity of the contract unless by express stipulation it is provided that the policy shall in that event be suspended or shall lapse. Exceptions: in case of life and industrial life insurance, whenever the grace period provision applies. Individual life or endowment insurance and group life insurance, the grace period of either is 30 days or 1 month within which the payment of any premium after the first may be made. Industrial life insurance, the grace period is 4 weeks, and where premiums are payable monthly, where the insurer acknowledged in the policy or contract of insurance itself the receipt of premium, even if premium has not been actually paid as expressly provided by Section 78 itself, where the parties agree the premium payment shall be in installment and partial payment has been made at the time of loss, where the policy provides for payment in premium in full before the policy shall be deemed effective, it's valid, and binding upon the company. The partial payment is merely treated as a deposit and does not make the policy binding. Where the insurer granted the insured a credit term for the payment of the premium and loss occurs before the expiration of the term. Where the insurer is in a estoppel as when it has consistently granted a 60 to 90-day credit term of the payment of the premiums. Is premium necessary for suretyship? General rule, premium is also necessary in order for the contract of suretyship or bond to be binding. Exception: where the obligee has accepted the bond, it is binding even if the premium has not been paid, subject to the right of the insurer to recover the premium from its principal. Note, the official receipts in question serve as proof of payment of the premium for 1 year of each surety bond. It does not, however, automatically mean that the surety bond is effective for only 1 year. In fact, the effectivity of the bond is not wholly dependent on the payment of premium. A policy of insurance upon life or health may pass by transfer, will, or succession to any person, whether he has an insurable interest or not, and such person may recover upon it whatever the insured might have recovered. On the other hand, property insurance cannot be transferred without the consent of the insurer because the insurer approved the policy based on the personal qualification and the insurable interest of the insured. If there is transfer of property insurance without such consent, the insurance policy is suspended and will not be avoided until the interest in the thing and the interest in the insurance are vested in the same person. Rights and obligations of the party. Who are the parties to an insurance contract? The insurer, the insured, and the beneficiary. What are insurance corporations? They are corporations formed or organized to save any person or persons or other corporations harmless from loss, damage, or liability from any unknown or future contingent event, or to indemnify or to compensate any person or persons to other corporations for any such loss, damage, or liability. To guarantee the performance of or compliance with contractual obligations or the payment of debt of others. An insurance corporation must have sufficient capital and assets required under the insurance code and pertinent regulations issued by the Commission and certificate of authority to operate issued by the Insurance Commission, which should be renewable every 3 years. What is concealment? Or what are the requisites of concealment? Okay, first, concealment is a neglect to communicate that which a party knows and ought to communicate. Requisites: a party knows the fact which he neglects to communicate or disclose to the other. Such party concealing is duty bound to disclose such fact to the other. Such party concealing makes no warranty of the fact concealed, and the other party has not the means of ascertaining the fact concealed. Good faith is no defense in concealment. The insurance code dispenses with proof of fraudulent intent in cases of rescission due to concealment, but not so in cases of rescission due to false representation. Should fraud be proved in concealment? General rule: fraud need not be proved or proven in order to prove concealment. Good faith is not a defense. Exception: when the concealment is made by the insured in relation to the falsity of a warranty, the non-disclosure must be intentional and fraudulent in order that the contract may be rescinded. What are the effects of concealment? General rule: concealment, whether intentional or not, entitles the injured party to rescind a contract of insurance, even if the death or loss is due to the cause not related to the concealed matter. Exception: incontestability clause. Concealment made after the contract has become effective, waiver of or estoppel. In marine insurance, in situations where concealment does not vitiate the entire contract but merely exonerates the insurer from a loss resulting from the risk concealed. What are the instances when concealment made by an agent procuring insurance binds the principal? When it was the duty of the agent to acquire and communicate information of the facts in question, where it was possible for the agent, in the exercise of reasonable diligence, to have made the communication before the making of the insurance contract. Failure on the part of the insured to disclose such facts known to his agent or wholly due to the fault of the agent will avoid the policy despite the good faith of the insured. When should an item be disclosed to the other? In good faith, even without inquiry. Party concealing must have knowledge of the facts concealed. Facts concealed must be material to the risk. Parties duty bound to disclose such facts to the other, and party concealing makes no warranty as to the facts concealed. Other party has no other means of ascertaining the facts concealed. Is inquiry needed for an item to be disclosed? The general rule: neither party to the insurance contract is bound to communicate information in the following matters. Exception: except in answer the inquiries of the other, like those of which the other knows, that which is in the exercise of ordinary care the other ought to know, and of which the former has no reason to suppose his ignorance, like political situation, general usages of trade. Those of which the other waives communication, those which prove or tend to prove the existence of the risk excluded by warranty and which are not otherwise material, those which relate to a risk accepted from the policy and which are not otherwise material. Should insurable interest be disclosed? General rule: the insured is not required to communicate the nature or kind or the amount of his insurable interest in the life or property insured to the insurer. Exception: when the insurer makes inquiry from the insured of the nature or amount of the latter's insurable interests.